Righty ho, and welcome to this, the third and final leg of my tour of Canada's mortgage ecosystem. And today we're going to talk about the third species of mortgage lender in Canada. We started with traditional and alternative, and today we're going to talk about the private mortgage lender, the world of private mortgages with the briefcases full of cash and the trench coats and the baseball bats. No. Today I'm going to allay a lot of what I think is the stigma associated with using private residential mortgage lenders in Canada. We're going to talk about what a private mortgage looks like, how much it costs, what are the advantages and disadvantages to them, and who these private mortgage lenders are. So let's start off with what a private mortgage looks like. If someone has told you, if your mortgage advisor has told you that in this circumstance we have to use a private mortgage lender, well, what is it? So these are short-term mortgages, and what they're designed to do by and large is to either take advantage of an opportunity or solve a short-term problem, and then you get out of these private mortgages by way of a refinance into a traditional mortgage lender, or you're just going to resell the property that you bought down the road because of a short-term opportunity. So what are the rates associated with private mortgage lending and the fees? Well, okay, June 2018, traditional mortgage lender, 5-year fixed rate, 3% odd. Alternative lender, 4%, 5% in change, plus a modest 0.5% to 1% fee. We get into private mortgages, and at least in my universe, my current experiences, the ballpark is that rates start at 7% and they go up upwards of 12%. And there's an upfront fee for the amount of the mortgage that has been approved is usually starting at 2% fee of the amount of the mortgage approved. So this is hefty. The payments for these mortgages are interest only because of the shortness of their term. And sometimes those payments can actually be built into the mortgage themselves so that from a cash flow perspective, there is no payment. Also, these mortgages are open, which means that when you pay them out, hopefully as soon as possible, they are free from penalties when they're being discharged, unlike breaking a mortgage at a bank, because of the fee that you paid up front. So that's what a private mortgage looks like. In terms of down payment, you're going to have to come up with at least 25% down payment, more typically 35% down payment or 35% equity in the property or properties that you're dealing with, because these mortgage lenders will allow you to tap the equity in one or multiple properties, and they can do a blanket mortgage in order to make something work. So that's what they look like. What are the pluses of private mortgages? Well, number one is that they're very low doc, which is to say that they are not document intensive, unlike applying for a traditional or alternative mortgage. They're looking for minimal documentation, like they want to make sure that your personal income taxes are paid. They want to make sure that your credit is decent, and their levels for credit worthiness are much lower than a traditional lender. Finally, the most important element of a private mortgage is the property, because they're taking less weight on adjudicating you as a borrower, and they're putting their risk adjustment on the actual property itself. They know that you're going to put in or have a lot of equity in the property. They want to make sure that the property is the value that everyone thinks, and they want to make sure that the property is in the condition that they hope it to be. So it's a very property intensive loan. Income is not a factor, as I alluded to just now. They're not as concerned about income at all as a traditional mortgage lender would be, because they know that their loan is short term. The only sort of consideration that they'll give to income is what's called reasonability, and that is to say they'll look at a couple of income docs at times and say, is it reasonable of us to think that given the size of the mortgage that we're giving this person and the rate and the payments involved, is it reasonable for us to think that they can handle this short-term loan? And if the answer is yes, they will proceed. The other attribute of private mortgages, and this is where it comes in really handy, is the speed at which these lenders can fund. So just going back to a traditional and alternative mortgage lender, you usually have to have an unconditional approval and commitment about 10 to 15 business days before they will actually fund the mortgage. Whereas in cases in which I've dealt with private mortgage lenders, these guys can fund in as little as 3 or 2 or even the next business day after they have a firm commitment, which will just comprise of an appraisal, a credit check, verification that you don't owe substantial property taxes. Boom, the deal is funded. So there's two contexts in which you can take advantage of that. Number one, opportunity. If you happen to make an aggressive offer on a property and you're trying to get a discount on the price and you're convincing the seller you need to sell to me, I can close tomorrow or this week. That may be what it takes to take advantage of an opportunity, and a private mortgage lender can play ball. The flip side of opportunity is problems, and that's where the best example is in cases where you have a client who is conditionally approved for a traditional mortgage, but at the 11th hour something goes wrong with the borrower. Perhaps they have unpaid income taxes, perhaps the income, which has to be so precisely qualified, is not what we thought it was, and that traditional approval falls apart, and we have subjects removed and we have to complete in a matter of days. That's when an experienced mortgage broker can bring in the most cost-effective private lender to swoop in and get the transaction done so that the borrower, under the advice of the mortgage broker, can fix whatever needs to be fixed, and then we can get out of the private lender back into the traditional or alternative landscape. So speed is a big attribute when it comes to using private mortgage lenders. So that's what a private mortgage looks like, and that's what the pluses and minuses of them are in terms of their big cost and their major flexibility. Who are these private lenders? And like I say, to allay the concern of people, if you are ever in a situation where you've been told that you're going to need to use private mortgage funds, put a mortgage broker between you and the lender so that your interests are protected. I work with a huge variety of mortgage lenders in the private landscape, varying from individual investors who can do very flexible short-term loans, to syndicates of individual investors who will pool their money together on an opportunity and bridge the gap between problems, opportunities, and time, right up to my most common use of a private lender, and that's what's called in British Columbia the Mortgage Investment Corporation, or the MIC for short, MIC. And these are provincially regulated reporting issuers. So for example, these companies have hundreds of individual investors with their money pooled, and they manage hundreds of mortgages on behalf of these investors. And these investors can make their investments. They are TFSA and RRSP eligible. And to make these investments eligible for those types of investments, these mortgage insurance companies, or MICs, they actually do audited financial statements, which they publish on a quarterly or annual basis very publicly so that the investing public knows what's going on. So the level of transparency and credibility is very high. And to be a mortgage investment corporation, you have to have at least one, if not more, licensed mortgage broker running the show, originating things, and making sure that things are compliant operationally as well. You've heard of some mortgage investment corporations, as I alluded to last time. Capital Direct, we've all heard the radio ads. Alpine Credits, we've heard the jingles on the radio. We've seen the billboards throughout Greater Vancouver as an example. But I work with other mortgage lenders in the private sector, a MIC called VWR Capital Corporation. Hi guys, in Langley, BC. You just look at their offering memorandum, which is a public document. They have almost $250 million of investors' money under management, and it's deployed over hundreds of mortgages, not only in British Columbia, but across Western Canada. So I hope that today's little chat helps to shed a little bit more light on what people might perceive as kind of like an opaque part of Canada's mortgage lending environment. Don't worry about private mortgage investors. Rely on a licensed individual like a mortgage broker and put them between yourself and a private lender if and when that time comes. So that does it for now. That's the end of my tour of Canada's mortgage ecosystem, describing the traditional lender, the alternative lender, and the private lender, and the different variations of pricing and risk, which is essentially what this is all about when it comes to people buying or refinancing a home in BC and throughout Canada. Hope you enjoyed. Happy hunting for a home, and I'll see you next time.